yesterday, the RBA paused interest rates at 3.6%, which was exactly what 50% of the market forecasters suggested. I think there's still further to go. I think the way I put it is I think that the RBA has arrived at base camp and it's waiting for the weather to clear so it can see the ascent to the final peak ahead. What the statement says is the board recognises that monetary policy operates with a lag. Yes, it does, and our models of the Australian economy show that that lag's around about 5 quarters. So given that the RBA has been increasing rates for about a year, it's time for its effects to start to happen, or just begin to start to happen. The RBA could pause for a month, or it could pause for a couple of months, but we think it's inevitable that rates have to rise again. The reason that we think it's inevitable is that given international comparisons, the RBA has a way to go. Firstly, our inflation is higher than the US. The US monthly CPI, which is shown in the Cleveland Federal Reserve website, on the front of their website, was 6%, whereas with our new monthly CPI, our CPI was higher than that. It was 6.8%. And on a seasonally adjusted basis, it was 7.1%. So inflation is higher here than in the US. And that's even more so when we look at the measures of core inflation for CPI. The Cleveland Fed shows that core US CPI, that is to say excluding food and energy, for the month of February was 5.5%, whereas our new monthly measure of the CPI shows on the same measure, which is excluding volatile items, which is how we talk about excluding food and energy, our core inflation was 6.9%, so way higher than the US, 1.4% higher than the US. And the statement goes on to say that the labour market remains very tight and unemployment is near a 50-year low, and underemployment is also low. Now, all of the historical relationships of very low unemployment mean that over periods when you have very low unemployment, in the couple of years after that, you have a rapid acceleration of wages. And so that's what we think will happen. There'll be a rapid acceleration of wages, and that will generate a rapid acceleration of prices. In this situation, and in spite of the fact that our inflation is higher than the US, our interest rates are lower. Our interest rates, the Australian cash rate is 3.6%, whereas the Fed funds rate is 4.8%. But as I've noted, the 3.6% is a climb below the Fed funds rate of 4.85%, but the Fed funds rate is expected to climb further to 5.1%. So in its closing remarks, the RBA says the board expects some further tightening. They expect rates to go up further. They expect some further tightening may well be needed to ensure inflation returns to target. And the board remains resolute in its determination to return inflation to target and do what is necessary to achieve that. So my view is that the RBA will, after a pause of a month, perhaps 2 months, have to resume its upward climb, and it'll finally reach a level where the Fed now is, but not where the Fed's going to get to. And where the Fed now is 485 basis points. So I hold to that view. Now, I was given a bunch of questions, given the amount of time we thought I would have this morning, to things to answer. Does the RBA holding rates change my view about interest rates getting to 485 basis points? No, it doesn't. I think it's just a pause. What is the fair value of the ASX and the S&P 500? Well, in response to that question, yesterday I ran both models, and fair value of the ASX 200 is currently 71.17, and that was 120 points lower than we were yesterday. And the fair value for the S&P 500 was 4,018 points, and that was also 106 points lower than we were yesterday. And that's with the updated levels of 10-year bonds, both in the US and Australia, and also corporate risk premium. Next question was implication for the Aussie dollar. Well, the Aussie dollar went firstly sideways and then slightly down in a situation where sterling was going up and the Singapore dollar was going up and the yen was going up. So the pause in interest rates has paused the ascent of the Australian dollar. Do I think that the Australian dollar will begin its rise when rates start going up again? Yeah, of course I do. And it'll move up moderately from here. I think I've said 70 cents by the end of the financial year and 75 by the end of the year. So the US market is currently not pricing in an inflation probability from here of the US entering a recession in the next 6 months. Well, the US would have an extremely high probability of entering a deep recession in the next 6 months, given the shape of the yield curve, because the yield curve shows that the Fed funds rate is significantly higher than the 10-year bond yield. Now, it would be the case if it wasn't for the fact that the US is an enormously large oil and gas producer. And we expect that in the final quarters of this year, the 2 final quarters, as oil prices go up, oil production in the US is going to, there's going to be a lot of investment, and that investment will generate growth. Were it not for that resumption in activity in the US oil and gas sector, you would definitely have severe recession in the US, given what interest rates are doing. And the final question to me was high points from the recent March Insto quarterly. I'm still got another presentation to do. I did a whole bunch of presentations to Instos last week, mostly in Sydney, but by video. Hope to do that presentation generally sometime in the next week. High points from the Insto presentation. The point which struck me was all the discussion about the Chinese recovery is about the effect on the oil price. But when I look at the content of my presentation, the real effect is not on the oil price, the real effect is on base metals. Because in base metals, copper is at the lowest level of stocks this century. And there's an enormous need for copper for the energy transition. If any of these plans to enormously increase electrification of developed Western economies take place, and there's plenty of funding for them, there's going to be vastly more copper needed than is currently available. And as I say, copper is currently at the lowest level of stocks this century. Also at the lowest level of stocks this century is, I think, is lead and also zinc at the lowest levels of stocks this century. Lead is still needed for electronic vehicles, and zinc is still needed for coating structural steel. And with the resumption of the Chinese steel industry, there'll be a dramatic increase in the need for zinc. Nickel stocks are low, but they're not the lowest this century. They're equal to the lowest since 2006. But so I think base metal demand rather than oil is the big story for China resumption. And that's the end of my, having answered all the questions I was given, that's the end of my remarks.